I want to thank everyone for joining me today. I'm going to be talking about the last 15 years of markets and what we're likely to face over the next 15 years. In the past 15 years, investors have been through 2 recessions and 2 sharp downturns of the stock market. These 15 years have been a true test of endurance for investors. Retired folks have had to cope with lower returns than they expected, and many have had to cut back on their spending. Younger investors have seen their savings accumulate at a much slower pace than in the past. Baby boomers have been particularly disappointed by these 15 years because, after all, they lived through the previous 15 years of absolutely booming markets. But what about the next 15 years? Are investors going to be burdened by a new normal of lower returns? That's a question that's haunting many of us investors. I wanted to start off with the U.S. stock market. You can see that there have been 2 steep declines in the S&P, as everyone knows, followed by 2 prolonged rallies. At the end of the 15-year period, the market's definitely higher than it was in 1999, but what a roller coaster ride. The collapse of the market during the financial crisis was particularly unnerving for investors. Over the 15-year period, U.S. stocks have had no equity premium at all. In fact, stocks have underperformed bonds by about 1.5% a year on average, with stocks earning only 4.2% per year. Over these 15 years, the poor performance of the U.S. stock market was matched by the markets in the foreign industrial countries. But emerging market stocks did much better, earning over 7% per year, and REITs outperformed even more with a 12.7% return. So in an otherwise disappointing 15-year period, a little diversification helped a lot. By the way, these 15-year averages hide a lot of variation over time. In 2013, the S&P earned 32.4%, but at the same time, emerging market stocks and REITs both had lousy returns that year. Let's consider how a younger investor would have fared during this 15-year period. I assume this investor is far enough from retirement to invest only 25% of the portfolio in bonds. 40% of the portfolio is invested in U.S. stocks and 25% overseas. Why is so much invested overseas? I think the proper answer is why not? Why confine the stock portfolio to companies that happen to be headquartered in the United States? To further diversify the portfolio, 10% is invested in the REIT market. I'm assuming that the investor is not wealthy enough to invest in fancy alternative investments like private equity or direct investments in real estate. The REIT market allows this investor to own a portfolio of commercial real estate indirectly through the REIT process. In this 15-year period of mediocre returns, how much could a younger investor accumulate? Let's imagine that this investor started with $100,000 at the end of 1999. If this sum were invested in a tax-deferred account, it would have grown to $254,000 by the end of 2014. Taking into account inflation, which averaged 2.3% per year, the $100,000 would have grown into $182,000 adjusted for inflation. That's not bad for such a period of relatively low returns. But what about the financial crisis period? How well did investors fare during that period? In particular, let's look at how those near retirement or investors already retired fared during the crisis. Suppose that the investor had accumulated $1 million before the crisis. How much of that money would be intact today? Let's assume the investor has a 50-50 portfolio like the one that's pictured in the chart. If the investor were not yet retired, not yet spending out of the portfolio, the $1 million fell sharply during the financial crisis, but has since recovered fully. In fact, by the end of 2014, the $1 million would have grown almost 40%. But what if the investor were already retired, and what if that investor was spending 4% per year, typical for a retiree? Then in that case, the portfolio is down at the end of 2014, but it's down by only 1.5%. That's not bad for the worst financial crisis since the 1930s. Older investors have been disappointed by the returns over the last 15 years. That's because they were spoiled by the abnormally high returns earned in the preceding 15 years. These 15 years started in 1985, included many of the boom years under President Reagan, and it includes the NASDAQ boom period under President Clinton. Over this 15-year period from 85 to 99, stocks earned an average return of 18.9% per year, or 15.3% after taking into account inflation. Bonds earned an average return of 9.2% per year, or 5.9% in real terms. If an investor had started with $100,000 in 1984, it would have grown into a princely sum. Let's follow this $100,000 over the next 30 years to try to imagine how lucky the baby boomers were. How much wealth would have been accumulated during this period? Adjusting for inflation, looking in real terms, the $100,000 would have grown into $1.1 million by the end of 2014. Baby boomers were indeed quite fortunate to have been able to invest during this incredible period. But let's look ahead at the next 15 years. What can investors expect to see? Many investors are worried that returns will not be as high as in the past. In particular, investors are haunted by the notion that a new normal of lower returns lies ahead. Bill Gross introduced the new normal in May of 2009. He predicted that we were in for a prolonged period of lower stock returns because growth in the industrial countries was likely to slow down. We might have to get used to a 301k instead of a 401k. I believe the reason why the new normal idea caught on so much with investors is that we were already worried that the recession had done permanent damage to the world economy. Let me point out that Bill Gross chose a bad time to introduce the new normal. We're about to embark on a classic stock market rally that has lasted over 5 years. This should not have been a surprise, because we always have a stock market rally at the end of a recession. Let's look at the rallies following the last 9 recessions in the United States, going back to the early 50s. The chart shows the S&P 500 return in the first 12 months after the market reaches bottom during the recession. In the latest rally, for instance, the market rose almost 50% in the 12 months starting in March of 2009. By the way, knowing that the market rallies after recession is not a recipe for market timing. First, the rally almost always starts before the end of the recession, at a time when investors least expect a rally. 2009, for example, the market rallied in early March, just 6 months after Lehman had failed. Second, it's very difficult to know when a recession will end. The last recession ended in June 2009, but few people believed that at the time. It was many months later, almost 12 months later, before we knew for sure that we were out of recession. In any case, if you bought into the new normal too soon, your portfolio would have missed out on one of the greatest stock market rallies. Yet Bill Gross may be right that stock returns in the future may not be as high as in the past. Future stock returns may not be as high because growth in the industrial countries has slowed down. Consider Japan's growth in the last couple of decades. Japan's Nikkei stock index reached a peak of 38,900 in December 1989. It has never recovered. And in the meantime, Japanese growth has stagnated at less than 1% per year. U.S. enjoyed vigorous growth throughout the 1990s, but since 2001, growth has fallen almost in half. Key European countries like France and Germany have seen a similar fall-off in growth over the last decade or so. One reason that growth has slowed down in Japan and Western Europe is that these societies are aging rapidly. That's particularly true of Japan, Germany, and Italy. The United Nations has projected how population will age from now until 2050. The share of the population over 65 will increase to over 30% in those 3 countries, Japan, Germany, and Italy. The U.S. population will also age over time, but even in 2050, we will have only a little more than 20% of the population over 65. Now, Bill Gross talked about a new normal for stocks, but surely we should also worry about a new normal for bonds. The Fed has kept interest rates abnormally low ever since the financial crisis through its quantitative easing programs. The Fed's intervention in the fall of 2008, so-called QE1, provided cash to commercial banks when they needed it most during the financial crisis. But more recently, QE2 and then QE3 provided ever more cash in order to keep both short-term and long-term interest rates low. The question is now, what happens? No one knows for sure, but let's consider two scenarios. In a good scenario, interest rates stay low indefinitely. So investors will be condemned to live with real interest rates close to zero or even negative. In the bad scenario, interest rates rise, leading to capital losses on existing bonds. Neither scenario promises normal returns for the bond market. I will leave it to the Fed watchers to tell us whether interest rates will start rising and by how much. But as investors, we should expect that bond returns will disappoint us. That is, a new normal for bonds seems easier to predict than one for stocks. If both stock and bonds threaten to have lower returns, is it possible to escape the new normal by diversifying? One possibility is to diversify into countries that are growing much faster than the United States, the emerging markets. Another possibility is to diversify into alternative investments. Let's explore each possibility. Let's consider diversifying into emerging stock markets. Since 2001, emerging markets have earned abnormal returns. In late 2001, Jim O'Neill, the chief strategist at Goldman Sachs, first coined the term BRICS. His speech signaled the start of a sharp rally in emerging market shares. Emerging markets earned an average annual return of 16.2% from 2001 to 2010. But more recently, emerging markets have faltered. Goldman Sachs itself explained why in a study entitled Emerging Markets as the Tide Goes Out, released in December 2013. Goldman researchers provided a convincing case why key countries like China and Brazil might deliver slower growth and lower stock returns in the future. Let's consider China for a moment. The World Bank recently predicted that Chinese growth would slow down enough by 2017 so that India's growth would surpass it. Chinese wages are rising and exports to the rest of the world are slowing down. There is reason to believe that China's growth will slow down even further over the next few decades. That's because China's population is beginning to age. Over time, China's aging will be almost as fast as Japan's. The United Nations predicts that over the next 35 years, China's working-age population will decline steadily from 2.5 times its non-working population to little more than 1.5 times that population. So emerging markets like China may not be the panacea that we once thought. What about alternative investments? Can they counter the trends in conventional stock and bond markets? Let's start with hedge funds. In the 1990s, giants in the industry like George Soros and Julian Robertson delivered handsome returns to hedge fund investors. But over the last 15 years, the returns have been declining. There are still managers who outperform regularly, but with 10,000 hedge funds competing with one another, average returns have definitely declined. Over the last 5 years, returns have averaged only 4.5% per year. What about commodities? For a few years earlier in the last decade, when China was booming, commodities seemed to be the ultimate alternative investment. Low in correlation with everything else, commodities began to boom, driven by the enormous growth in China and other emerging markets. But now we understand that this was a temporary boom. Only the low correlation of commodities with stocks remains. So let's turn to private equity. They may be worth considering. Here at last we have an alternative investment that has proved itself time and time again. Cambridge Associates has reported private equity series since 1986. Returns have been consistently above those of the private equity markets. My advice to endowments and wealthy families wealthy enough to invest in private equity: take advantage of excess returns to buck the new normal in public markets. Unfortunately, most investors are excluded from private equity investments because the minimum investments are so large. So what are the rest of us to do? I think we have to take it for granted that we are facing a new normal for bonds, at least in the immediate 5 to 10 years ahead. Bond markets have to adjust to a more normal Federal Reserve policy. In the meantime, investors must take a defensive stance, choosing bond durations much shorter than normal. I'm not as convinced that the U.S. stock market will sink into a new normal. Surely the U.S. economy faces a brighter future than many of its critics contend. First of all, the U.S. remains the center of innovation in the world. We are home to half of all venture capital investments. Startups are the norm rather than the exception. It's not just social media. Even the taxi industry is undergoing a revolution. Second, the U.S. actually celebrates entrepreneurs. The climate for entrepreneurs matters. That's why so many talented engineers and scientists want to come to this country. Third, we're in the middle of a new energy boom. 155 years after the first discoveries of oil in Pennsylvania. Cheap energy has lowered the cost of manufacturing, so manufacturing is beginning to shift back to the United States. In the meantime, growth should stay rapid in many emerging markets. It's true that Chinese growth has slowed down from its earlier torrid pace, but 7% growth is still impressive. Two other BRICS have had troubles recently, Brazil and Russia. But other emerging economies such as Poland and Mexico have kept growing. And there are hopeful signs that India's new government will turn things around for India. Look at how different Colombia and Peru, to take two examples, look today compared with a dozen years ago. Even Africa is beginning to grow again. Yet to be prudent, investors need to prepare as if a new normal is coming. What do we have to do? I think we have to rethink some of the basic rules of thumb that investors have relied upon over the last 20 to 30 years. To save enough for retirement, investors of modest income have been told to save 15% of their income per year. By the way, that's not enough if investors earn higher incomes, because Social Security replaces a smaller fraction of your income the higher your income. Also, we'll have to reconsider the spending rule. Once investors enter retirement, they're told to spend only 4% of their wealth per year. That 4% may be asking too much of markets in the future. Maybe these simple rules will have to be modified in the future if the new normal prevails. All of these issues are discussed in my new book, Investing for a Lifetime, published by Wiley last June. Thanks for listening to this webinar.